Hi, this is Amey from FinQuest Institute. In this video, we'll understand a dollar roll transaction. This is an important transaction which is done in securitized markets. Now, specifically something which is conducted in a TBA market, which we call as a to be announced market. So as we know, for an MBS securities pool, we have a specified pools market and a to be announced market. These are the two avenues in which our transaction happens. So TBA, as we know, is a forward market, and we assume this to be more as a secondary market, and there is a good amount of liquidity which is offered by the TBA segment to market participants. Now, to understand what this transaction is, we need to evaluate two things. One is evaluate whether buying the roll is profitable, or would it be better to hold the underlying pool. So we need to decide among the two, and that decides whether a certain transaction in will become profitable or not. A dollar roll is very similar to what we have studied previously as a part of the repo transaction or a repurchase agreement. So we know that repo market is something which is very liquid and which is frequently used by banks and other financial institutions for various funding requirements. So a dollar roll transaction would follow on similar lines. There are a couple of differences, though. We'll talk about that in a moment. Now, to understand how this transaction works, the buyer of the roll, so this is one of the parties to the transaction, they sell the TBA for a front month settlement. So what is a front month settlement and a back month settlement? This is something which we'll cover as a part of our simple numerical, which we'll discuss in a bit. But the buyer of the roll is going to sell the TBA for a front month settlement, and that happens at a specified price. And simultaneously, they are going to buy the same TBA back using a back month settlement at a lower price. So the exact transaction we'll discuss through a numerical example, which will bring more clarity to this point. Now, before we go to the numerical, it would be a good idea to quickly do a review of the difference between a repo transaction and a dollar roll transaction. Now, firstly, in a TBA market, we have the CTD option, or what we call as the cheapest to deliver option. Now, this is something which we frequently come across as a part of interstate futures. So when we do interstate futures trading, and if the counterparty has to deliver a certain bond, then they can select a cheapest to deliver bond. So a similar concept can be applied here as well. As a result of this, what happens is the security that is repurchased back may not necessarily be the same as the security which was sold in the front month. So there can be differences in securities. Now also, interest is not added to the repurchase price. Again, something in contrast to the repo transaction, because we know that in a repo transaction, whenever the borrower is going to repurchase the asset, that repurchase has to happen at a certain higher price. And that higher price is there to account for the interest in the transaction. However, in a dollar roll transaction, this interest does not get added in the repurchase price. Now, in this, the borrower misses 1 month of interest payment from the pool, and the counterparty earns 1 month of interest. So that is how the interest adjustment happens in a dollar roll transaction. Now, let's understand a couple of terminologies which we observe in the dollar roll market. So, the idea of a forward drop. So this is technically defined as the difference between the spot price and the forward price. Now, historically, it has been observed that the forward price is lower as compared to the spot price. Now, how do you value a dollar roll transaction? Now, this is essentially the difference between buying the roll and holding the pool. So if you recollect, in the last slide, we discussed these two ideas exactly. So we said we need to evaluate whether it is profitable to buy the pool or whether it is profitable to hold the pool. So we need to figure out which one is profitable, and we make that transaction. Now we need to figure out the difference between the two. So there is a specific approach which is used to calculate this difference. So we need to value both the sides, buying the roll as well as holding the pool, and we evaluate what that result is. Now there can be three scenarios in a dollar roll. Now if buying the roll is equivalent to holding the pool, so this implies that the roll trades are at break even. So another technical term which we see. Now, if the value of the roll is positive, Now, when I say positive, we are again talking in terms of the forward drop, and we know that forward drop is the difference between spot and the forward price. Now, if the forward drop is large, such that buying the roll is profitable rather than holding the pool, we call it as the roll being above the carry. Whereas if it is the other way around, that is, if the roll is negative, we call the roll as trading below the carry. So these are three technical terms which you come across in a dollar roll transaction. Now we know what the transaction is. We have studied the basic terminologies which are required in this market. Now let's try to understand through a simple numerical example as to how do you do a valuation for a dollar roll. So we have a security which is backed by Freddie Mac. So we know that Freddie Mac is a GSE or a government-sponsored entity, and let's say it's a 5% security. The settlement prices as of June 12th and July 12th are 102.5 and 102.15 respectively. The days of accrued interest are 12 days. Now we have calculated the amount of accrued interest here. Again, a simple calculation. I just need to unannualize this rate of 5% because since we are focusing on 12 days here, we need to unannualize this for 12 days. So that is what precisely we do here because we have a 30-day month. So we do a 12 by 30. So we accrue the interest for 12 days. That comes out to be $0.1166. The expected total payment, total principal paid on is taken as 2%. The going short-term interest rate is 1%, and the notional or the outstanding notional, as we call it, is taken as 10 million. So these are the things which are a given, and now we can focus on the actual calculation for evaluating this dollar roll. Now we are going to do two things. We have two sides to the trade, right? One transaction which happens in June and the other transaction which happens in July. Because again, as we know that a dollar roll is very, very similar to a repo transaction. So firstly, we sell the June TBA and this comes out to be a certain number. Now, how do we arrive at this number has been shown on this section in green. We simply take the notional of 10 million. We have the settlement price given to us for June 12th, which is 102.5. We add the accrued interest. So the accrued interest is going to be added to both the sides of this trade. So something which happens in June as well as something which happens in July. So we'll see the adjustment of $0.166 in both the places and we divide it by 100. So this gives us the value for selling the June TBA. Now we can calculate the interest earned. So that interest earned will be dependent on this interest rate of 1% which is given. So we have this value which we just calculated into 30 by 360 into 1%. This comes out to be around roughly 8,500 US dollars. The second transaction is purchasing the July TBA. So again, a similar transaction. Here we have the settlement price, which is given as 102.15, which we write here, and 0.166 is nothing but the amount of accrued interest. So as I mentioned previously, we'll be adjusting the accrued interest in both the positions, the June and the July position. So the purchase price is nothing but the notional of 10 million and we have a bracket. So we are adjusting for the total pay down of notional which is happening. So 1 minus 2% into the settlement price for July, which is 102.50 plus 0.166, which is again the accrued interest upon 100. So this gives us a purchase price. Now, in order to calculate the net proceeds, I need to take the difference between the two. That is, I need to take the difference between what has happened for June and what has happened for July. So I can sum up the first two rows because these are something pertaining to the June side of things, or maybe the first leg of the dollar roll you can assume. And the second one is this transaction which you have just done, which is the purchase price. And the difference between the two is going to give us the net proceeds. So that net proceeds comes out to be roughly $248,189. Now we need to compare this against what happens if we hold the pool, because these are precisely the two things which we are comparing, right? We are comparing whether it is profitable to roll the transaction or whether it is profitable to hold the pool. So we are done with part A, you can assume. So this is part one of the transaction. Now this needs to be compared against a value, which we call as holding the pool. So the calculation is done here. Again, we take the notional of 10 million into the rate of 5%, because here simply the coupon is going to accrue, or we are going to earn that coupon. So 5% upon 12 plus the 2%, which is the expected total paid down of principal. Now this comes out to be around 241,667 US dollars. The difference between the two, which is the difference between the roll transaction and holding the pool, is what we call as valuing the roll. This comes out to be 6522 US dollars. Now we observe that this is a positive quantity. So when it's a positive quantity, it's called as trading above the carry. So we have summarized the calculations on the right hand side. So the accrued interest, so something which we are shown in this section in green, have been again elaborated for a better understanding. We are honestly just doing two things. We are calculating the position for the rolling transaction by taking into consideration the positions for June and July. So that's like part A of the transaction. And part B of the transaction is what happens if we decide to hold a pool. So we take the difference between the two and we see whether it's positive or negative. Now here the roll is having a positive value. That means that it's trading above carry. So this is how we do a dollar roll valuation. So hope this video was helpful. Now, dollar roll valuation is a concept which is tested as a part of FRM examination. So to know more about our FRM course, log on to our website www.finquestinstitute.com. Thank you.